when was the last boom in fundraising? And that would have been 2022 of the step-ups that everybody had in their portfolios. These vintages of 21, 22 are not gone till 30, 25, 26. This is when the investment periods will finish. If people want to spend money, okay, everybody can get themselves an extra year of investment period, and then it has to be deployed. So I'd actually imagine that the wall of dry powder that needs to be deployed in Southeast Asia is quite significant. And that's what's causing the leakage into restaurants and coffee shops and whatnot, because folks are running out of imagination as to where to put the money. So I wouldn't worry about the current drought until maybe 5 years from now, at which point there will be a boom in the market and foreign investors will just come and take the niche.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
Hey, Dmitry. Hey, Shiyan. Last episode was about, February 2024. We were discussing, and our title was Dislocation, Overreaction, and Confusion. Now the sequel, a year and a half later. We are here because we are so excited to help launch your new Central Ventures report on Southeast Asia ecosystem. And literally, I was trying to understand the ecosystem, and I was like, I need Dmitry's report, and it's coming out. So thank you for sharing.
Thank you for accelerating the process. Otherwise, I would have published it in November.
Well, just in time September for Super Returns, right? Super Returns Asia. So I'm sure lots of people will be using it to, prime the conversations. So why don't you just tell us what were the headlines, and then let's go from there.
I do refer our audiences to the 2024 and February, was it?
Yeah.
I think that was actually a very seminal conversation, I believe, which shall be much quoted in today's discussion. But highlights, we have lost mega deals, which is as predicted. We have not lost them entirely. There's a bunch of Japanese investors that still are willing to bet significant amounts of money on mostly digital banks in Southeast Asia. So we still have about 300-400 million worth of those every half a year. We have, I think, stabilized the core stack, or what we call the core stack, which is our local community of VCs. Up until, I'd say probably we stabilized it until second half of 2024. And then something happened. And I'll comment on that. A third bubble has popped. Previously, we talked about post-COVID bubble, and we talked about zero interest rate bubble. What we didn't talk back in February 2024 was Indonesia bubble. So that will collapse. But up until then, I think the core stack held at its usual bill every half a year, give or take. We have started seeing the beginnings of recovery. In the middle of 2024, tech, and especially fintech in the Philippines, start dragging the ecosystem out of doldrums. It's not visible in top line numbers, but if you remove all the other verticals, you'll see fintech going back up. And we lost all the secondaries and all the IPOs. I think last secondaries were the eFishery secondaries, famously. What we do have now is a bit of data that I still haven't figured out how to track, and that would be the liquidity that happens post the point of listing, which is to say, take privates. You have noticed a couple of billion-dollar companies going from public to private. And a whole bunch of block trading in the public companies. People are realigning their positions, having seen what public markets do to assets from Southeast Asia. What else have we got? Yeah. We have the freeze in Indonesian ecosystem, and we have the beginnings of a dawn, whether it's real dawn or folk dawn to be confirmed in the Philippines. That's where it started.
All right. So much unpacked there. I want to hear a reaction from Shiyan. What are you thinking?
I think when he said we were going to quote from 2017, or from our last conversation, I think it was that the projection was that we were going to reset the funding environment to 2017 levels.
That was an expectation, yes. We've reset it to 2016, I believe.
So we underestimated how bad the winter would be. Because even then, I think that if you had asked me even 1 to 2 years ago, I was thinking that it would probably be set to 2018, if you ask me, in terms of funding levels. And even then, when you say 2017, it's already an aggressive end from my perspective. But now we're back to 2016, and maybe even counting. I mean, you never know, right? It could get worse. I'm not saying that it will get worse, but I'm just kind of curious about that. I thought it was a very strong headline they had, which is that the Southeast Asia ecosystem in 2025 has reset to the 2016 funding levels. So is that like a bubble that we had that burst, or is it because we've kind of like done some structural damage to ourselves, or how you see that narrative from your perspective?
Well, look, what drove the 2017 spike onwards? That's way before COVID, right? The unicorn religion. So the mechanics, the gears that locked to each other are the belief that large consumer population in Southeast Asia will produce multi-billion-dollar outcomes, which brought people from around the globe that made it their specialty to fund creation of unicorns. Availability of such funding automatically created unicorns where they shouldn't have been. And that created a generation of investors whose business model was to sell into unicorn rounds. So you've had first successful step-ups and bits of liquidity in 15, 16, thanks to those initial unicorn building rounds happening in Southeast Asia. By 2017, folks who learned these lessons raised their first funds. From that point, it was off to the races. Now these folks have lost their narrative, so they're no longer investing. So no wonder that we are resetting to that previous level of activity. Minus the interest rate effect, minus the COVID effect. I would say that's the crudest structural skeleton of the concept of explanation of where we are now.
I'm just curious because, from your perspective, it's almost like three different stories from my perspective, at least from the slides that you shared. I think the first, of course, is that we're back to 2016 aggregate, but you're also saying that there is a core funding stack that's still relatively stable. Large deals and the deals have collapsed. So could you share a little bit more about how you're thinking about it?
Let's break it down. So we have, when I say core stack, I mean a collective community of funds that have raised enough capital side by side with a bunch of corporates who have allocated enough capital to supply local startups with roughly billion and a half every half a year. I think at our normal cruise speed, that stack has been doing, if you remove the madness of 2021, 2022, 1.5 every half a year. That capital is still there. Quite a few corporates have withdrawn. So maybe core stack's capability is now more a bill every half a year. Up until second half of 2024, that's exactly what the ecosystem was deploying. Mega deals or no mega deals, market freeze or no market freeze. The only half a year period where we see even that threshold breached is second half of 2024, because we lost Indonesia. And Indonesian corporates and Indonesian VCs who took our recommendation, by the way too close to heart. Because when we spoke in February 2024, I think Shiyan was talking about the option of, what was it? For mid-cap private equity without leverage? Is that how we defined it? But what we meant was orienting the funds towards modest outcomes and building technology stories. I think most of our colleagues in the region took it straight into investing into pizza parlors and coffee shops and bubble tea. So mid-cap private equity for sure. And those numbers we do not track because we don't count technology adjacent companies as investments that are worth tracking in this report. Hence the numbers.
I think that's actually an interesting piece. And after that, I'm happy to hear Shiyan's point of view as well. But I think what we kind of saw early has recrystallized, which was I think a lot of funds have started pushing into like the private equity adjacent space, right? So maybe there's a tech-enabled start to it, but it looks like F&B chains, it looks like ice cream shops. So I think there's an interesting dynamic there. And I think the jury's still out of my head slightly, which is that good or bad in the sense of, I mean, the classic Silicon Valley VC is going to be like, oh, that's not technology or RVC. But there's another piece that's also saying like, Kopi Kenangan was able to grow Luckin Coffee as well. And you look at Misha in China as well, component and chain and franchise is also doing really well. So I think there's a little bit of those two kinds are still warring, I would say, about whether that makes sense or not. I don't know if thoughts about that. Either of you.
I stick to the original definition of a startup, right? It's an organization that's trying to discover its business model, quickly innovate, and find a way to a solution with whatever technology is available. Some of the food and beverage concepts in the region are doing exactly that. They're experimenting with inventory, with recipes, with mixes, using it economics, with access to various kinds of consumers. I mean, they're as startup-y as any startup, but there's a few exceptions. Most of the time, it's a well-designed, well-predictable cookie-cutter approach business that is being built for profitability. Private equity, as we know and love it. So there is no such thing as right F&B or wrong F&B. There is some F&B that's highly innovative, and then there is the rest of it, which is a whole different asset class, even if it has an app.
Well, I mean, I think investors at the end of the day, you want to invest in stuff that makes money. Whether it makes money kind of slow and steady out of the gate, or it makes money in some sort of tail outcome in 10 years, that's just different allocation in people's portfolio, right? And so I think the definitions matter to the extent that like there's a set of institutions and families that say, hey, I want X% of my portfolio to have these characteristics. Venture capital has these characteristics. So these things that I'm allocating to are going to perform in this manner. And so the GPs down the line who are receiving this capital are like, okay, this is my mandate. I need to invest in things that look like this, that can produce this kind of return. And so like, you know, I think if you can build a great ice cream shop or whatever and it delivers steady returns and it hits the bar that your LP has asked you for, then that's fine. But I think in general, when people think venture capital, that's not kind of the shape of the return people think of. And so I think when I made my earlier comment about small cap private equity is that like, because of some of the supply and demand for capital in this region, if we underwrote tech-enabled services more like small cap private equity and priced it correctly, you could, I believe, still get a venture type of outcome.
One keeps hoping.
That's a good T-shirt. One keeps hoping.
But I guess we digressed into the food and beverage concepts because I was just trying to explain why numbers in our particular work using our particular methodology look down. It's because, we do not count the classic private equity investment unless our team of analysts can discern some sort of a technical innovation that sits inside the company that just looks like a food and beverage concept. So it's very opinionated, very subjective measurement. So bottom line is the core stack continued to deliver middle of 2024, and then something happened. And that something is still to be parsed.
And I think you used the word, which is that, you know, we had a zero interest rate era. The bubble popped, I think, for that funding. I think we've talked about it in our prior podcast. What was interesting is that you said that the Indonesia bubble has popped or is being passed. And I think that's something I want to unpack that phrase because we're still, I think, honestly, even I'm still processing that, what it means actually. So I'd love to hear it. Maybe we'll start first with your quantitative view first, and after that we'll talk more qualitative views. Dmitry, how do you think about it from a quantitative view?
Sure. You deprived me of an opportunity to talk about zero interest rates, but we'll get back to that. Sure. So I would suggest we return to the notion of, what was it? Confusion that we discussed last time around. Remember, if listeners would like to re-listen to us blabbing on about confusion back a year and a half ago, the way we spoke about this was lack of a unifying narrative. A unifying narrative is what brings a bunch of investors together to think the same way about the opportunity space. And so there was a very clear fixed narrative as to what Indonesia is. In fact, there were several narratives. There was the consumer story, enough digital middle class to sustain something that lists at 40 bill. There was a second narrative that said that this is a rich fabric of MSMEs that will consume digital services and financial services at the scale of India. And then there was a narrative there was some blue ocean and blue economy narrative. There was a bunch of others, some EV and nickel narratives, but basically these two were the primary ones. And so there was a cluster of money that built big platforms, and there was a cluster of money that funded B2B transactional platforms. And those activated international capital, and those brought forward capital formation domestically in Indonesia. Both narratives fell apart way before the events of eFishery. We are talking disruption in the early and middle 2024, and some of them even in late 2023. eFishery was still a legitimate business back then. So what fell apart? I think it's the results of the big IPOs. It was the results of big IPOs, and it was a general cooling of the late stage ecosystem that just couldn't take this many B2B platforms, which put pressure on founders to do interesting things with numbers, and then we know what happened. That itself is qualitative. I'm not yet talking numbers, but I think it took out three core sources of funding. There are very large corporates in North Asia that will never touch anything to do with fish or Agritech ever again. So this is a few $100 million a quarter of the market. It took out, at least paralyzed, the will to invest by several large local platforms that are pivoting in the search of a new focal point. And most vividly and most recently, but that's the events of the last few weeks, not the last year and a half. Large corporate funds in Indonesia started winking out of existence. But that, I'm afraid, is something more to do with the local knife fight politically than the macroeconomic considerations.
This word narrative is an interesting one, right? Because in a sense, humans we love to tell ourselves stories. So the story of Indonesia in the context of the story of Southeast Asia is like, okay, we know what China looked like, we know what India looked like. We wanted to superimpose some of those characteristics onto this new market. And I think at first blush, Indonesia looked great for that, right? All those people, young demographic, good digital adoption. And so money kind of like flooded into that. And then I think what we learned is basically that the core limiting factor was actually per capita GDP. And there are a lot of people who also don't have money.
Per capita GDP corrected for Gini coefficient. That is the critical difference. The GDP actually looks pretty good. But when you realize that the GDP only ends up in the pockets of 50 million people out of 300,
Yes.
that puts a different texture.
Yeah. So there's a big cliff, basically. There's a drop off in how that GDP is distributed. And so you can't grow a consumer business at scale because your basket sizes are small. And then the geography of Indonesia is such that your cost to serve actually is high because your logistics costs are high. And the rails on the money movement was still being built. And so that wasn't exactly cheap either. That's
Counter argument, payment systems got upgraded.
Yes.
Fintech in Indonesia is now halfway to India in terms of sophistication.
yes.
Most of the population with money is actually very conveniently and densely located in Java. And if you price your consumer goods just right, it is still a decent market. But that is the problem with these four arguments. They do not fit into a convenient narrative. They do not fit into a simple summary report to the overseas investor.
Yes.
So Indonesia has not even lost its narrative, not yet. It got its narrative nuanced and capital formation stopped.
I think this is really interesting because, I was just recently reading the Asia Partners report from about 2 years ago. And obviously, one of the three paths they mentioned was obviously one was the Indonesia-only approach. Secondly was the regional approach, often Singapore and Malaysia headquartered. And then third, of course, was the Vietnam emerging, kind of like mini conglomerate, kind of like approach for market sizes. I think there's this, I think it was an easy way to put that framework. But I love what you said about the part about income inequality, because I think, not to get social political here, but I think the existence of the middle class or strong middle class is actually a really important piece for technology adoption, either whether it's kind of consumer or ride hailing or food delivery, I think it's on one end, or I call it education or digital education. There's so many things about it. But I think the Indonesian middle class, and I wouldn't say the narrative was wrong, maybe like say 7 or 8 years, 9 years ago, but maybe it just wasn't supported or delivered by the economic actors, the political actions, the regulatory actions. But like basically we saw
Was inaccurate.
we were optimistic and we were working towards that optimism where everybody would get.
As it is a story about the future. The future wasn't delivered.
The future wasn't delivered, right? So I'm not saying I was wrong because, we all had a part to play in it. And the middle class was growing in Indonesia. And then now they're getting hammered, costs of living, inflation, Chinese competition, right? For SMEs. There's a lot of, not enough cutting of red tape, the entrepreneurial actions. I think these kind of dynamics are making the middle class pull back. And so I just think that, I just putting a little bit of pin here actually is like not necessarily wrong. Maybe you're overly optimistic about, the actions of the whole ecosystem, especially in Indonesia.
May I protest slightly?
Please, go for it. I love for you to protest as much as possible.
Just ever so gently, because if you read and I apologize to my dear friends at World Bank, but if you read World Bank stats on the middle class in Indonesia, you will be heavily misguided. $1 a day is not middle class. Something somebody in the developmental organization made up as a number that's useful for various KPIs. You go and you talk to the digital platforms like Tokopedia and like GoCheck, and you see how many spending users they have. Numbers will range between 12 and 20 depending on an average ticket. That is your digital middle class. It's just a fact. So people who shoot for that population and for outcomes in, shall we say, $500 million to $1 billion are perfectly okay, and there are no complaints about middle class. In fact, it's much more cohesive. High spending per capita than some of the other countries. Everybody was shooting for a middle class of 70. Well, therein lies a surprise, right? So just research.
I think this is nuance, right? Because nobody was writing that in the fund text. Indonesia middle class or the serviceable addressable market is only 50 million or 20 million.
I'm sure Rahmat Daily Social was, but he wasn't widely circulated.
Everybody was writing 300 million and rounded up from 279 million to 300 million. So,
hey, public reports of GoCheck are there and available. You can see number of spending users.
I think actually there's a really good insight there, actually. Yeah, I think you basically, if you are the founder, you should say, if you use GoCheck, you're a potential customer.
Yeah, everybody in Indonesia knows these numbers.
Yeah.
So it's only just the overseas investors that were willing to, shall we say, state the case of the country for a variety of incentives that we all know.
Okay, so we're saying,
So nothing terrible happened to middle class. I'm saying it on record. Nothing terrible happened to middle class in Indonesia. It's still there, give or take.
It's still there.
But anyway,
But it didn't grow as fast as we thought.
fair point, but then we shouldn't have expected it to grow. Middle class in Southeast Asia generally doesn't grow. It becomes ever so slightly richer, but it doesn't expand. That's the thing for every big capital in Southeast Asia. Maybe it was an exception of Vietnam 7 to 8 years ago.
Yeah, I think Vietnam is eventually expanding the middle class.
Yeah, in numerical terms. The same fixed number of people, whether it's 10 million or 6 million, 12 million, depending on the country, that's ever so slightly richer every year.
Right.
That's just how the local economies are for a variety of things that are way above me. Reasons that are way above my pay grade while I'm in Singapore jurisdiction.
I think that one thing that we also talked about a little bit is like, it's not just that, but also I think you mentioned that the bad faith actors also has had an impact on this. Like I think Agritech was one of the big shining verticals of Indonesia 3 years ago. Right, we obviously had eFishery, we had aquaculture, and other agriculture. So I think definitely bad faith actors has kind of like also spiked the system as well.
Me, I try to reframe it into occasional heightened visibility of bad faith actors that were always there. Is that a more complex construct of our non-leveraged private equity income? The incentives to cause casual misalignment of interest have always been there. Founders who build for salaries, some founders who build for secondaries. When there is not enough funding for everybody, that naturally, organically spills over in every ecosystem, in every part of the cycle, into mild versions of fraud that occasionally spike into systemic fraud. For some reason, the story of Zilingo in Thailand was not the stick of dynamite blew the ecosystem up in 2022. For some reason, you had to hit the right note with Gibran and eFishery in January 2025. That's just happenstance. It doesn't mean that Indonesia suddenly overnight became more fraudulent when the rest of the region is perfectly clean.
Yeah.
Welcome to emerging markets. It's just sometimes things come into focus and get looked at. And sometimes we carry on cheerfully, regardless of how Zilingo has been doing to its numbers. The theory of Indonesia has started crumbling after the big IPOs. Not enough capital for everybody. A lot of late-stage investors stopped writing checks. A lot of precursors to the media firestorm that consumed us all. Could have been somebody else.
Do you think, okay, at least for, some of the stuff like eFishery and eFishery, I think, we obviously saw the reports that came out about fraud allegations. They became confirmed and then Gibran confessed to it. On Bloomberg.
I'm not entirely sure what he confessed to. I think he just proclaimed that he did it for the people, which in light of most recent events in Jakarta streets might actually be quite a popular statement.
Well, the key thing is he confessed that he did it. Yes, caught just for some reason on Bloomberg.
The founders think that way and do not see a reason why they should put some abstract shareholder needs over the needs of living, breathing human beings the employer serve.
Yeah.
So there is that in Southeast Asia, and Gibran is actually not much of an outlier. Going on Bloomberg is pretty special though.
Yeah. Exactly. I think this is, so there's two parts to it, right? So the first part is, it's like when you say like when you're digging for shit, like how much more shit is there? So what you're saying is that it's more systematic.
I'm saying that this is a systemic risk that will not go away after the ecosystem picks back up. It hasn't started with Indonesia, it hasn't started with Gibran, but there is a number of incentives that have coincided in the right time and the right place to set it off as an explosion in January 2025. Would have been much healthier if that bomb went off in 2020, but we were distracted with the pandemic. That's when it should have really gone off.
Yeah, I do believe that if these things were caught like one stage earlier, like at 2020, you would have really done a lot of work because everybody would have like improved their governance, improved their due diligence.
Doing funky things with peer-to-peer lending, using investors' money to pay loans to hide NPLs, or being attacked by criminal syndicates, then suborn your business into transfer of money from your investors to eventually people who pretend to be your customers. That's not 2025 thing.
Yeah.
That's 2015 thing.
Yeah.
If not 2030.
Yeah.
So this stuff has been in the ecosystem since forever. It's about slow, steady work by the regulators, by the investors to weed it out and upgrade to the better business models that do not allow for such things to happen. But we had a firestorm of capital and a little bit too much enthusiasm, and so all sins have been washed away by the boom of 2019 onwards. So eFishery was a bit late, to my taste.
Yeah, I agree.
We just need another bro to wash it away.
Guys, yeah, I'm sure there will be something interesting. Yeah.
Well, Trump gets hit what he wants, right? He's gonna look
my big grades. Remember where I come from.
I think of one, which is basically what you just said, which is there was a very hot trend of adding embedded fintech or embedded lending into platform businesses, which could potentially work, but was just badly managed, executed, tracked, and governed, right? So the core thesis that I think was very popular at the time was with this book of, let's say, 10,000 SMEs, and we want to help them grow faster because as they grow faster, they buy more from our platform. So we're going to create a lending arm to fund them so that they can grow faster and build up working capital. And I think the way where it fell upside down was that we tracked the platform business based on platform metrics, but we tracked the lending business as a platform business. And so the revenues were being counted as loan repayments was considered as revenue instead of like thinking very deeply about the return rates, etc., non-performing loan, governance. So to me, I think that was one of the, in retrospect, one of the crazier, very hot beliefs that became very popular in the businesses looking to build more, asset light or capital efficient or lending business on top of their businesses. Anyway, I think that's my point of view on kind of a badly executed belief, I would say, at minimum.
So was the belief bad or was the execution bad?
It's tough.
Because those can be great businesses.
Yeah, I'm of a view that's pretty much the only way to wrap financial services around most of the economy and most of the population. But, everything in moderation. So if you're lending to SMEs on the platform has to have some sort of a leverage over said SME. So if you are trying to find those rare and hard to find situations where the context of lending determines success of lending, then you're okay. If you're just selling money at a discount, you're not okay. But that has nothing to do with the embedding principle. You can just as well lose money in the standard BNPL model, but just do unsecured lending and small checks to a mobile phone without KYC. Easy.
Yeah, I know.
So there are ways to set your money on fire.
Interesting debate that will require a couple of hours. My favorite from 2021, you say, I hope I got the year right. For half a year, every time I would turn on CNBC, there would be a story about the same story every time, about the future of work and how employment of people in a vast economy such as the Philippines can be entirely managed, consumed, and facilitated by a crypto-based, by a blockchain-based game. That one was my personal favorite. Let's not mention names, although North Korea, I think, raised about $500 million for its missile program from that particular company. But I think there's as a whole concept, as a concept of imagining productive employment by means of distributed ledger technology-enabled game, I think that was the top for me.
It was a crazy time. That was a crazy. I always felt like I think the entire picture about it was like kind of like pay to earn, right?
Oh, there was a run to earn, there was a breeze to earn, there was a bunch of, there was like a click to earn. But again, one thing is the creativity of game designers in the darker corner of Telegram. It's a whole different thing to talk on a mainstream media channel for almost a year, actually, about the notion of productive employment for the entire nation within a virtual world. I felt that losing my mind.
Yeah, I remember being very skeptical about that because I always thought like, hey, you work to earn, but you play to earn. Is then what are you doing? What's the product, right?
What was your fondest memory from the boom year?
Probably all the random supply chain software businesses. Yeah, everyone who had a family business doing supply chain something or another found a tech guy and was like, I know a lot about this vertical. I'm going to digitize it. I'm going to embed finance in it, put working capital through it.
You see as if it's a bad thing.
It's not. But basically everyone who had some sort of connection to some sort of...
Shall we say it together? Okay, 3, 2, 1. Chicken farms. Hey, some are very good businesses. Some of my best friends are investors in some of those. But seriously, that one is my second best memory from those years. Supplies of chicken feed to chicken farms, digitized through a variety of things.
Yeah, I think that was the thing where it's like every Tom, Dick, or Harry was trying to digitize some vertically specific supply chain.
Yeah.
Yeah, well, we might, but in the next iteration of the ecosystem, I'm pretty sure that there will be $6 billion businesses that will be built around the right parts of the agriculture ecosystem, because it's sustainable economics, tea and coffee, that for sure. And some aquaculture, once we forget a little bit the disaster of last year, actually makes a ton of sense. Just, you need to choose the right configuration of the market and not go butting heads with CP Group for a start.
Yeah.
And those things.
I think that at the end of the day, I hate to say this, but I do believe that Agritech in Indonesia makes sense because it's such a new sector, a lot of inefficiencies, and everybody knows that agricultural productivity is an order of magnitude worse. There's money to be made. Whether that money can be made on a venture type of dynamic, as a time frame and outcomes, I don't know. But I do think money can be made there. And I think there's a set of funding models or entrepreneurs who can make it work.
It can be made. A bunch of reference models, and Latin America has a bunch of reference models. You have to choose the right commodity in the right market configuration at the right part of the value chain.
Right.
The eFishery almost got it right.
Yeah.
It was just a little bit of inflation, a little bit of extra expectation from the investors, and one thing led to another.
And I think the crime in terms of, eFishery, if you look at it a little bit more kind of from an economics perspective, is that it fundamentally misallocated a lot of capital that could have gone to more productive startups in different parts of the value chain and therefore expand a lot.
I don't know if that's true, though.
I keep disagreeing with this
Yeah,
argument.
that's true.
Let's go.
Because the bulk of the money raised was at the later stage.
People were buying a long, big growth story.
Yeah.
And if that big growth story were not to be presented,
They wouldn't have put that money into earlier
they
stages.
would have parceled it into 300 small bets. It's
Yeah.
a very nice narrative, but no, that's not how it works.
People don't like hanging out in the pre-seed where I am.
Series A plus where I live, yes.
But that's why I disagree. Because they wouldn't have written those checks.
Sure. I think I understand that from that perspective. But it is kind of catastrophic for all the agritech founders in Indonesia right now. They can't.
I mean, people built businesses before venture capital existed. And the cost of doing technology-enabled anything only continues to go down. So I don't think it is impossible for people to start out and say, hey, I want to prototype my product lightly and cheaply. I want to see how I go.
Yeah.
And I think if they got themselves to a place where they're like, oh, like I'm doing 10K, 50K of revenue a month, and I think this thing is starting to have legs, went and said, I want to go try to raise 500K. I think there'd be money for that. But I think the days of like, hey, look at the fish thing over there, come look at my prop thing over here, and now give me $1 million. I think that doesn't exist. So I don't think that like people can't do it. It's just that you can't take the fast track. And that's probably okay because you probably should figure out the economics of what you're doing before you jam a bunch of cash into it.
So there's ground game argument, there's an air game argument, right? On the ground game, allow me to suggest the following thought experiment. Let's go to the cleanest, most efficient location in Southeast Asia, Singapore. In the last 10 years, we had scandals in nickel, in gold, in real estate, in money laundering, oil bunkering, I believe. Massive collapses, huge companies, billions of dollars lost. Does it mean that the business of oil bunkering has been wiped out across the region? Does it mean that commodity traders stopped? Does it mean that remittances and wealth management have been frozen dead? So fundamentally, agritech value chain makes sense, and it's one of the biggest pieces of local economy. It will work, and the eFishery's business model was not the worst. There are several business models, and you need to parse it. But presently, the air game has a bit of a problem, because just like you never get fired for investing into IBM 30 years ago, now you absolutely get fired for touching agritech for at least half a year if you're in Seoul or if you're in Tokyo. People are leaving good companies over this particular transaction. Give it time, a year later, nobody will remember. Who remembers Zelina? Only people at Sequoia, and they've already rebranded.
I was just kind of curious, I think you have some other slides that you shared as well. For example, we talk about, you said capital efficiency, right? So talk about industry. You mentioned that fintech and certain kind of companies are more capital efficient as well. Could you share a little bit more about that? I think that's maybe a good way to think about the future as well.
Sure. This is one of the more convoluted slides to explain in our deck. But what we've done was we looked at valuations of companies in Southeast Asia that have reached their liquidity event. Not necessarily the last liquidity event, but the first liquidity event, the mark of an IPO, let's say, or the first trade exit. And then we just straight up divided that enterprise value by all the capital that they've consumed to get there, with obvious results. The most obvious and the most flashy and the most known champions of Southeast Asia are below one, which means that they've taken on board more capital than they've ever had a chance to return. The very first liquidity event they've had, they might have recouped some of the investors' losses later after trading on the market for a couple of years. A little bit tricky to trace. On the other side of the equation, you have companies that have, say, had an exit of 100, 200, 300 mil after raising 10, 20, 30. So they have a 7x, 10x, 12x capital efficiency. Doesn't mean that every investor benefited equally. Doesn't mean that the founder has necessarily made a lot of money. Most of these cases, actually, founder did make a lot of money and retained quite a bit of their cap table. So you build companies across this range, and then you have a look as to what sorts of businesses cluster in the more capital efficient corner. And that is in direct contradiction to your thought about embedded finance being a pretty evil thing to do, because the most capital efficient businesses are either straight up fintech enablers or platforms with significant digital financial services on top of them. And that's pretty much it. The slide has become our religion and our investment thesis and the core belief about the future of Southeast Asia.
Do more fintech, size on capital.
Bet more on the scalable fintech enablers or find digital platforms that are smart about deploying financial services would be my formulation.
So our portfolio is 70% North America. Most of the emerging markets portfolio is fintech platform.
That's the season. And I would imagine that it's pretty well proven by our forerunners in Latin America. We can talk a little bit about the analysis we do about different emerging regions and whatnot. But I'm starting to really arrive to a conclusion. To quote my Churchill, we're not in the beginning of the end, but we're in the end of the beginning. In the end of the beginning, and we're concluding that we are in the end of the beginning of what eventually gave us Latin American ecosystem 6 or 7 years ago. I think we're lagging behind LATAM 5, 6, 7, sometimes 10 years, depending on which countries you pair for comparison. And if LATAM teaches us anything, that regulators eventually catch up, legislate decent rules about lending, decent standards for fast payment systems.
So why is that? Why is emerging markets and fintech at the right juncture and so forth? Why is it a good fit?
Because now we've had 10, sometimes even 15 years, depending on the country, to learn what doesn't work in the classic business models. Chart, if you like, a matrix where vertical rows are your industry verticals, again, from protein, aquaculture to manufacturing and construction. And horizontally, you look at the business models, your software as a service, your marketplaces, your transactional platforms, what have you. So now we have had every permutation. We now know how blue-collar marketplaces are malfunctioning and how travel software doesn't work, what doesn't convert and where the leakage is. There is now a very clear way to patch up most of these deficiencies of most of these business models because it's becoming quite clear that some of this stuff is leakage because settlements are not controlled. So do payments correctly, for that sake. Some of these things are not working out because you're not retaining the merchants, or merchants struggle with working capital. So figure out a lending scheme. Some stuff is just too risky stuff and the trucks get lost all the time and fall off the wagon. We'll introduce correct risk pricing and get some insurance going. So it looks like after 10 to 15 years of experimentation, we all arrived to, some of us arrived to a conclusion that financial services is a tool for the job. It's the way to patch up digital business models that work better with it than without it. And have a look at all the large players in Southeast Asia that have claimed profitability recently. And look at what's driving their profitability, with a major exception of Grab, from even Gojek, not to mention C Group. Look at what is driving their profit markets. It's financial services applied correctly.
Everything becomes fintech.
So you said 70% of your portfolio in emerging markets is fintech. So what's driving that? I mean, obviously you're doing it from a bottom-up perspective. I'm just kind of curious that what's your learnings or insights about why you've end up that shape of that portfolio for emerging markets in fintech?
To be clear, sorry, 70% of the portfolio is North America. Of the emerging markets portfolio, so the 30%, the bulk is in fintech. Why is that? It's one of those things where, regardless of the per capita GDP, it's one of those things that helps the economy move better and faster. Like, there isn't a place where someone's like, oh, I have so much access to credit. Everyone has this problem. And if you can find the right team with the right sort of controls and choke point, you can make money on it. So then the question is like, where is it, right? Because like we said earlier, you can't just be selling $1 for 95 cents. That doesn't make any sense.
That's so fun though.
But you can't confuse, cheap cash with product market fit. But when you do have like control over inventory or control over the thing that they want, and all you're doing is facilitating that by like time shifting how money moves and being paid for that, then you can build something that has like real staying power because everybody wins in that situation. And also I think I like a bit of regulatory moat that you have to kind of fight through a bunch of rules. You can't just cowboy through it. One, I think it sorts for founders in a specific way. And the other is that it buys you a little bit of, competitive distance. I don't know.
Depends on regulatory regime and how pleasant it is, but yeah, generally agree. I do have an intuition, a hunch though, that not every GDP per capita allows for financial service. So payments are welcome pretty much everywhere.
Yeah.
Like African countries formed by civil war.
Still need to pay for
that
stuff.
takes off is telco facilitated payments, and sometimes they work better than elsewhere. But I wouldn't say that insurance companies are ready for anything below 9 to 10 GDP per capita. It's like you are switching on a whole new operating system on top of the existing digital ecosystem.
Yes.
And it comes in blocks. It's not switching all at once. Which brings me nicely to the notion of, does everything need to be on distributed ledger? Nah.
I do think there's an order of operations, right? So the first thing is like super basic, like payments. Like, can I move money from point A to point B to like pay for my good, right? And then I think after that, there's credit. Right? Because that is the thing that's always in like super short supply when your economy is poor. even when your economy's rich. But like that's the thing that moves things faster, right? That spins the wheel is credit, access to credit.
It's a level of control over risks of extending credit. It is always in short supply, as you point
Yes.
out. But in some GDP per capita scenarios, you just cannot control collections.
Yes.
And you cannot collect data on who you're lending to. So some degree of state capacity needs to be present to set some rules about how data is to be collected and used. That's where we get into the wonderful world of regulators and
Yes.
regulation.
Yes.
But
I think insurance and investing are probably the other two things that come later. Well, savings products first, maybe. Savings.
Low-end crypto propositions, wealth management propositions, they seem to actually appeal more to the lower GDP per capita to relieve the desperate human condition.
I think the difference between wealth management is helping you invest versus, I think, savings products versus flat out Ponzi schemes.
But the thing is, like, you
They
can't
don't work
have.
the same.
All the schemes actually gambling side.
Yeah,
It's
yeah.
probably fast.
But you can't have investment products until people have saved something to invest, basically.
So I thought before 2021.
I think maybe you just kind of like start to tie things up here. If you look at the future, if we were to make a prediction, years time, let's say together again, etc. Thoughts about how things are going to happen, how do you think it's going to happen? I think, Dmitry, I know you had something to say about Philippines. I think this is something that you're seeing.
And I think we're seeing more of a false dawn than a real dawn, but
Yeah.
hey, for what it's worth, this is an engine that drives the spend on fintech in Southeast Asia currently. Maybe not last. But I don't think you're asking me about the next 6 months. You're thinking, how long will it take me to produce the next report? 2.5 years? I think about next 2 to 3 years. So back to the topic of confusion. I think when we talked about dislocation last time around, I meant the longer term impact of the changes that we were going through, because some of the players in the ecosystem have a lot of inertia.
Well,
I'm thinking large allocators and large corporates. So they are only in the process of changing tack from how do we conquer the prosperous middle class of Indonesia to how do I stay away from Southeast Asia altogether. So we'll have to suffer for 2-3 years, just like after the collapse of rocket internet, when everybody in Northern Europe cursed the emerging markets as a whole, thanks to some of the businesses that rocket internet has built. So I think for a couple of years, we have to earn the credibility back as an ecosystem in front of just about every Japanese and Korean corporate, quite a few in China. So that's the dislocation bit. The confusion bit is everybody is in search of new narratives to invest into. And in our last conversation, I expressed hope that TNT practice of Goldman will finally come up with a new and interesting scheme, but we've been suspiciously quiet since FMC trading marketplaces. So I guess we'll have to fend for ourselves. My proposal is to start looking at Peru and Bolivia and Colombia and Mexico and eventually Brazil, and hope that our markets here graduate to the level of sophistication of those markets in the next 5 to 7 years. That would be my hope. It's not a given narrative yet. It's not what everybody agrees to, but I hope we'll converge on that and start building. And that's my optimistic scenario. My pessimistic scenario is India 2010. Total collapse, complete loss of credibility, and then 6, 7, 8 years of restoration. I think the region has passed that point.
That's interesting between India 2010 collapses one hand and Peru.
And Brazil 2024, when new bank generated $1 billion.
Nothing against Peru, but I'm just saying,
Following Latin America in its footsteps is about the right recipe. Stop chasing India and China, shall we? But that's not a forecast, I guess. That's wishful thinking. Forecast, as always, I have no idea. I'm in charge of figuring out what happened in the past. That's the report. It never has a page about future-looking statements.
no feature that will save us in the report.
It's our colleagues in the industry. We do a lot of that.
Yeah. Okay. Shiyan, what are your thoughts about it? Next one.
I mean, I think I'm not as good at like the broad sweeping statements. I think Dimitri's a lot better than that. I sit in the pre-seed, right?
Yeah.
So for me, like the big drivers are like talent, capital, and market. And I think the talent in the ecosystem is better than it was 6 years ago when I moved back. Right. And so partially it's that you have more experienced people recycled through, they've learned something. Partially it's geopolitical, you have people coming in who've had experience operating at scale. And even the funding ecosystem has learned its lessons, right? So I think that all contributes to like talent in ecosystem. So that feels to me like positive. I think all of this bubble bursting actually has made founders a bit more sensible and more realistic. So that feels good. And so then the tools that they have in front of them, I know we don't want to talk about AI, but I do actually think people can go build more interesting things faster, cheaper now. So then it's just up to people's ingenuity to go do it. So I think I'm cautiously optimistic about that.
Yeah.
Like, it doesn't do us good to sort of wring our hands, right? I think it's more like a bunch of builder groups that I'm in, like people are like prototyping, they're trying all the new models, they're shipping stuff. And so then it's just like, can they take that energy and enthusiasm and turn it into like something people want to pay for?
That's your shot, right? It's like,
Yeah. Did you make something people want to pay you for?
I guess we're both talking about what we wish would happen. Why don't we go back to what is actually happening already, just not getting covered much? I've never seen this many poorly covered, large, profitable digital companies in Southeast Asia, from Line to Creativo, from Gcash to Time Bank, which is now more and more Southeast Asia than it is South Africa. With all the noise about the failed IPOs, yes, how many more times can we dance on the grave of Bukolapa, right? And with all the eFishery to bingo with, what we're forgetting is that my own reports have always been saying that the height of achievement of a Southeast Asian digital player is a $500 million exit. My research is starting to contradict it. There is a dozen players that are ready for $1 billion exit.
Yeah.
If they are smart enough not to try to go for 10. But a few of them are ready for 2 or 3. Was that not a good result of the last 12, 15 years? They're just all sitting there very quietly waiting for the IPO windows to open. And the best of them are already getting $300-400 million pop investments from North Asia. Mega deals did not stop, but they're now going to the right people for once.
And on your LATAM connection, New Bank invested.
Yeah, the Brazilians are coming.
I think from my perspective, I think that in the next 1 year at least, I think I read this interesting Industry Asia report on, I think, the amount of venture capital being raised by venture capital funds. I think it's a 7-year low, is pretty much. And I think, to me, I thought it was interesting because from my perspective, obviously, this year is a 7-year low for dry powder being raised by funds. And I think this is a leading indicator for the amount of venture capital that can be deployed in the next few years. So for me, I think my perspective for the next 1 year is I think that we won't see an uptick in local venture capital fund deployments into the capital. And so I think the capital constraint, from my perspective, is going to still be high in 1 year's time. So that's my point of view on that. And that's going to be something that early stage founders have to be aware of. So they have to focus on angels. I think they have to focus on syndicates. They have to focus on the customer cash.
That's Monty's customer.
Definitely. Maybe from the banks, working
Please-
capital,
please
credit card debt.
Please don't.
But I think
Banks come through.
I think the Series A, Series B gap, that values is going to get harder and tougher as well. I think that's my point of view. While I think, like you said, I think those companies that have already gotten past that Series A, Series B debt value, like you said, have already continued to figure out their business models, etc. I think they'll continue to grow nicely and survive and thrive to some extent because of less competition in that sense.
I'll be unknowingly optimistic here. When you look at those reports about VC fundraising, what's more useful to look at is when was the spike? When was the last boom in fundraising? And that would have been, if I recall correctly, 2022 of the step-ups that everybody had in their portfolios, or in some cases of the nice exits in their portfolios. These vintages of 21, 22 are not gone till 30, 25, 26. This is when the investment periods will finish. So in fact, I think people want to spend money, okay, everybody can get themselves extra year of investment period.
Yeah.
Maybe a year and a half.
Right.
And then it has to be deployed. So I'd actually imagine that the wall of dry powder that needs to be deployed in Southeast Asia is quite significant. And that's what's causing the leakage into restaurants and coffee shops and whatnot, because folks are running out of imagination as to where to put the money. So I wouldn't worry about the current drought until maybe 5 years from now, at which point there will be a boom in the market and foreign investors will just come and take the niche.
I'm optimistic.
It will not impact the founders. It might decimate a few local VCs, but the founders will actually be in a good place.
Yeah. Okay, so to wrap things up, we
On that note,
On
it's
that-
positive.
On that note, thank you so much for coming and sharing.
Thank you so much to the audience for suffering us. Thank you for hosting us. Till 2 years from now in the next report.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.